All right, my voice is back to normal. So let's give a 2 week market check. Simple, useful, and no doom scrolling required for this. So Freddie Mac's weekly survey gives us a clean national average snapshot. The last 2 weeks have consisted of 6.09% and 6.01%. So we're getting that slow drip down. Now 6.01% is the lowest level we've seen in quite a while, and hopefully this trend will continue throughout the year. Obviously, it's not a big drop type of thing, but expect a jagged drop down moving down throughout the year. So one thing to clarify here is to remember that this is a national average and your real rate will depend on your credit, your down payment, your loan type, and whether you're doing things like a temporary buy down when you're buying a house. Now, one of the biggest housing headlines is that home builders are leaning hard into incentives because affordability is still tight and buyer traffic has really been sluggish. A recent read on builder sentiment shows that it's still below neutral and incentives are still widespread, things like closing cost help and rate buydowns. So why does this matter to you? Now, when builders sweeten the deal like they've been doing, it really can do two things. It gives buyers more ways to make the payment work, and it can create more competition for resale homes nearby because buyers suddenly have more options. If we break it down even more, why have rates eased over the last few months? One big reason is the inflation has been looking calmer. The National Association of Realtors noted that the latest CPI reading shows inflation rising above 2.4%, one of the slower paces we've seen since early COVID years. So why overall does that matter? Well, lower inflation pressure usually helps keep mortgage rates from jumping because investors don't feel like they need to, get a higher return to protect against their rising prices. So what's the what happens next headline with the Fed and jobs data? Now it really comes down to the fact that the Fed is still in a wait and watch mode. Governor Waller literally described the next rate cut decision as a kind of a coin flip, and it comes down to the upcoming jobs and inflation data. This is very similar to the message that Powell has been stating that the Fed is going to be data dependent. If we want to break this down in more plain English, if the economy looks like it's hotter, rates can bump up. And if it looks like it's cooler, rates can drift down. And that's why we can see mortgage rates move even when you don't feel like anything in real life has changed. Now, the bottom line is that rates have improved a bit over the last 2 weeks and a lot over the last 6 months. Builders are still dealing and trying to get incentives to home builders to buy. And then inflation has been behaving better than it has been in the past. So if you want me to run numbers for you in plain simple English, whether it be for buying, selling, refinancing, or you just have a simple question of what would my payment be if I did this, shoot me a message and I'll pressure test it with you. If you got any other questions, let me know.